Support and resistance basics. Risk to reward ratio. In this lesson, we will focus on how to use support and resistance levels as a way to improve traders' profits. According to their trading style, and of course based on the time frame that they use, every trader should choose a risk-reward ratio that he feels comfortable with. These reward-to-risk ratios are the key to finding and executing high-yield, low-risk trades, regardless of whether a trader is using daily, weekly, or monthly graphs or charts, or any other form of indicator. Always bear in mind that every trade carries a certain level of risk, and trading success is all about making as much as you can when you are right and losing as little as possible when you are wrong. There are several different trade setups that offer profit. Although they use different indicators to analyze the price movements, they have two things in common: high reward and low risk. Knowing the amount of risk on each trade is one way to limit your losses and to protect your trading account. It also means that you know your profit target. A disciplined trader will take an average system and make money with it, but an arbitrary trader will take a brilliant system and wreck it. Since losing is an inevitable part of this game, a trader should learn how to minimize the risk and increase the reward. Low risk. If you choose your entry points near support or resistance, you will be reducing your risk because you can close your position with a small loss if that support or resistance is broken. High reward. Perhaps exits are more important than entries because perfect entries are almost impossible. When you decide to open a position, you should make sure that prices have enough room to go. In the real world, risk-to-reward ratios aren't set in stone. They must be adjusted depending on the time frame and market environment. However, some traders believe that the ideal should be 1 to 3. That means you are willing to lose 10 pips in order to gain 30 pips, or 100 pips for 300 pips. The reason we try to trade only these high reward and low risk ratio situations is that we can be profitable without having a high percentage of winning trades. The chart below shows an ideal setup for low risk and high reward trade. You may not recognize all of the terms or understand why we have strong support and resistance. For now, just know that the entry is at strong support and the exit point is at strong resistance. What does this chart illustrate? There is an opportunity to open a short position near the strong resistance formed by certain support and resistance indicators. Prices try to break this resistance, but the bears successfully stop their advance. As a result, prices reverse. Once this setup is confirmed, we can open a short position with a stop loss above the resistance level based on the risk-reward ratio and enjoy the ride. Once we find setups with high reward and low risk, we can open long positions near support or short near the resistance. Once the trade is executed, we then place a stop-loss order according to risk-reward ratio. For long positions, support is near the likely low for a given period. For short positions, resistance is near the likely high. We go long near supports or go short near resistance because the odds of price moving against us are lower. And if support or resistance is breached and our stop-loss is hit, we exit while our loss is small. How to place entry, exit, and stop-loss orders is a big topic by itself, which we'll cover in a lesson sometime down the road. You must understand that in order to use this strategy, you need to be good at identifying strong support and resistance points. The reason to restrict ourselves to trading only these kinds of setups is that we can be wrong most of the time and still be very profitable. Here's a math example that illustrates the logic behind. Consider that for each trade, we risk $50 for $150 with $10,000 in capital. And now let's look at the possibilities if we open 10 positions. If you lose 10 straight trades, which can happen, you would lose $500 or 5% of your capital. If 50% of the trades won, your profit would be 150 times 5 minus 50 times 5 equals 500 or 5% of your capital. If 40% of the trades won, your profit would be 150 times 4 minus 50 times 6 equals $300 or 3% of your capital. If 30% of the trades won, your profit would be 150 times 3 minus 50 times 7 equals 100 or 1% of your capital. In other words, even if you were wrong 7 times, you are still a winner.